AI is already deciding who gets hired, who gets approved for credit, and who pays more for basically everything. And most people have no idea it's even happening. Here's what I mean. Right now, algorithms are scanning your social media, your spending habits, even the way you type on a loan application. They're building a financial profile of you that banks, employers, and insurance companies are using to make decisions. And here's the thing, you don't get to see that profile. You don't get to correct it. You just get the result. Approved or denied, hired or passed over, low rate or high rate. This isn't some distant future thing. It's happening today, and it's creating two groups of people: those who understand how these systems work and know how to position themselves, and those who don't and end up getting quietly filtered out of opportunities without ever knowing why. By the end of this, you'll understand exactly how AI is being used to sort people financially, where the biggest risks are, and what you can actually do to make sure you're not on the wrong side of that line. Because in a world where everything's rising and margins are tighter, being invisible to the right systems or flagged by the wrong ones can be the difference between building wealth and staying stuck. Let's start with credit because that's where most people feel this first. Traditional credit scores look at payment history, credit utilization, length of credit history. Pretty straightforward. But now, lenders are using AI models that pull in hundreds of additional data points: your job stability based on LinkedIn activity, your spending patterns from linked bank accounts, even things like how often you move or whether you shop at discount stores versus premium ones. They're building a risk profile that goes way beyond your credit report. And the scary part? These models can deny you or charge you higher rates based on patterns you didn't even know were being tracked. There's no legal requirement for them to explain how the algorithm decided. You just get a vague rejection letter. Here's another one: hiring and income potential. More companies are using AI to screen resumes before a human ever sees them. The system scans for keywords, job tenure, even the schools you went to. But it also learns from historical data, which means if a company's past hires came from certain backgrounds or zip codes, the AI might unconsciously favor similar profiles. If you're outside that pattern, your resume gets filtered out. You never get the interview. You never get the chance to explain your skills or work ethic. The algorithm just moves on. And this doesn't just affect whether you get hired, it affects your lifetime earning potential. Miss out on a job early in your career because an algorithm didn't like your resume format? That sets you back in salary, experience, networking. The gap compounds. But here's the part nobody talks about. AI is also being used to decide pricing. Insurance companies are using machine learning to set premiums based on behaviors you might not connect to risk. How often you're online late at night, whether you've searched certain health terms. Even your social media activity can signal lifestyle risks that bump your rates up. Same thing with dynamic pricing for loans, mortgages, even car financing. Two people with the same credit score can get wildly different offers because the AI thinks one is more likely to accept a higher rate or default under pressure. You're not just competing with other people anymore. You're competing with a prediction model that's guessing your financial behavior based on data you didn't agree to share. Now, let's talk about where this creates the real divide. People who understand how these systems work can game them. They know to clean up their digital footprint. They know which apps and services share data with financial institutions. They know to optimize their resumes for ATS software. They're strategic about their online presence because they understand it's being monitored and scored. But most people don't know any of this. They're just living their lives, and behind the scenes, they're getting scored, categorized, and filtered. And once you're on the wrong side of an algorithm's decision, it's incredibly hard to reverse because there's no transparency, no appeals process, no way to know what went wrong. This sounds smart, but it's actually wrong to think you can just ignore this because you have good credit or a stable job. These systems are always evolving. A habit that's neutral today might be a red flag tomorrow. And the people building these models aren't thinking about fairness. They're thinking about accuracy and profit. If the data says people like you are slightly riskier, you'll pay more, even if you're personally responsible. So what do you actually do about this? First, assume everything you do online is being tracked and potentially scored. That doesn't mean you need to live in fear, but it does mean you should be intentional. Clean up old social media. Be mindful about what you link to financial apps. Don't give companies access to your bank data unless you absolutely have to. Second, build traditional financial credibility that's harder for algorithms to misread. Keep your credit utilization low. Have a long, stable credit history. Maintain consistent employment or document income if you're self-employed. The stronger your traditional financial foundation, the less weight those fuzzy AI signals carry. Third, know how to position yourself for automated systems. If you're applying for jobs, use tools that scan your resume the way ATS software does. Make sure you're hitting the right keywords, formatted cleanly so the algorithm can actually parse it. Same with loan applications. Be precise, be consistent across platforms, and avoid anything that might flag as irregular. And fourth, diversify where you apply and who you work with. Don't rely on one bank, one platform, one employer. If an algorithm doesn't like you at one place, try another. Different companies use different models. What disqualifies you in one system might not matter in another. Let me pause here and clarify something. I'm not saying AI is all bad. It's made some things faster and more accessible, but it's also made financial decisions less human, less flexible, and way less transparent. And that creates risk for anyone who doesn't understand how the game is being played. Here's the bottom line. AI isn't just a tool anymore. It's a gatekeeper. And it's deciding who gets access to credit, jobs, better rates, better opportunities. Most people are walking into this blind, getting filtered and sorted without ever knowing why. But once you see how the system works, you can adjust. You can position yourself in ways that make the algorithm work for you instead of against you. It's not about being paranoid, it's about being aware. Because in a world where machines are making more of the decisions, the people who win are the ones who understand what the machines are looking for. You're not powerless here. You just need to know the game has changed. If this helped you see something you didn't notice before, share it with someone who needs to hear it. And I'll see you in the next one.